Hello, welcome to the Market Carver. I am Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you so much for joining us. As always, we truly do appreciate the clicks and the follows. Helps us know that you're staying connected. I truly appreciate the time. This week, we're going to talk about an increase in global travel, and then Andrew is going to take a look at how few stocks have been able to keep up with this overall market. So let's drive right into an increase in global travel. So, first, I'm going to set the stage here a little bit and bring in the US dollar. We've got so many questions about this over the last several years. We've talked about it on this market carver. Our allocation team put forward a paper you're welcome to have, by the way. Just give us a buzz and let us know you'd like to read our thoughts on the dollar and whether or not we should worry about an impending doom of it. And of course, our thesis is that most of those fears are way overblown. And in fact, one of our more prescient concerns was that the dollar would be a little bit too strong during this era, not too weak. Because you have the Federal Reserve raising interest rates and more rapidly than other countries, that can draw capital in. And that's one thing Andrew talked about in the investment meeting last week was just how much capital had been coming into the United States post COVID. It's something like 1/3 of all the global capital. So we've actually seen the dollar strengthen, but fortunately not to the pace where it would be a concern. And we could see some benefits from that. And mostly it is to the US consumer who wants to travel abroad. And indeed, we have seen a true spike in that. You can see that on this chart, which goes back over a many number of years. Of course, COVID, it just crashed and nobody was able to travel globally. And then we saw a huge breakout finally in 2023, and that moving on up and out. And in fact, if you go back now, we are beginning to very cleanly outpace 2019 levels in most categories, and notably into Europe. But this is healthy. Both is good for the U.S. consumer and is great for a couple of our portfolio companies. So just wanted to highlight that there is more to the dollar and its impacts on the global economy, and we have to look at it from that angle as well. So, Andrew, that is the U.S. dollar and some good things we've seen out of that instead of the opposite, which was expected. I'll turn it over to you to talk about again this narrow market.
Thank you, Adam. It was good to finally for us to be able to talk about something that's positive. I know we've had kind of a streak now of not great charger data points to share, so I appreciate you bringing up one good thing, seeing everyone traveling. Wish I personally had some more travel plans on my calendar. Would love to get out there and see some more things. But now, okay, now shifting focus to the stock market again. Last week we've talked about, and for several weeks, the narrow participation, the lack of a lot of stocks really joining the rally, and how we've really been focused to get a lot of the gains that we're seeing in the broad index, heavily relying on just a handful of stocks. This was a really interesting chart that I found from Morgan Stanley. Their chief investment officer shared this chart looking at the percent of stocks going back to the 1960s that are able to outperform the index over a 1 month period. Traditionally, again, because the market is truly made up of multiple stocks, of individual stocks, what those stocks do dictates what the index does. And so we often see rotations to where you have some stocks outperform and then another handful that aren't. But traditionally, they all pretty much keep in line with what the index does. That's a much different story than what we're seeing today. So, if we look at the chart on the far right hand, that red circle, you have to look way at the bottom. You can see we're very, very low, barely 20% of the 500 stocks in the S&P 500 are able to actually keep up with the index. You'll notice this is the lowest level we've seen since the 1960s. Never in the past have we been in a period where very, very few stocks are able to keep up with the market itself. The reason that what causes that is right now we have a lot of just a handful of stocks that make up the lion's share of the index. They're making up a very large weighting of the S&P 500. And so if those stocks alone do well, the index does well, regardless, in many cases, of what all the majority of the stocks themselves are doing. This makes it very difficult for a lot of active managers to be able to perform well, and they begin to chase and taking on a little bit more risk maybe than they initially planned to. But this is something that is a very unique market environment. We've gotten very close to these types of levels. We can see coming out of the COVID crash, we look back during the dot-com bubble, we got down into the high 30s to where it was just a narrowing breath time period there. And then the Nifty 50 stocks as they were coined back in the 70s. But even those periods saw a little bit more participation than we're seeing today. And so the result of that can be either the market begins to correct and be able to respond to the lack of growth seen by the majority of stocks, or we start seeing a healthy rotation to where a lot of those stocks that maybe have underperformed begin to perform and show strength once again. And that rotation can be the lifeblood of a very strong bull market. And that's what our team is really focused on, is looking at which direction does the market go, which path do we take in the weeks and months ahead of us.
Thank you, Andrew. And I know many of you watching, because I have conversations with you. You're students of marketing. You know some history there. So I appreciate Andrew going back, and I'm sure the Nifty 50 rung a bell to several of you. And I just appreciate seeing this context, because really this is interesting to really see the third real wave that I'm aware of, as Andrew mentioned, that Nifty 50, the late 90s, and then again, truly unique market circumstances. So, again, thank you all. And as always, we'll give you a reminder, if we can be of service, give us a call, 800 928 4001, or scan the QR code and book it electronically. Thanks again, and have a great weekend.